Hey, what's going on? Today I want to talk about tax diversification and why that matters so much for retirement. Now, you're not going to be thinking about this, but your parents are probably thinking about this, because I've seen most of the people I engage with are about my age, 30 years old. So, tax diversification, what that means to me is that you need to remember that your investment accounts get handled differently when you draw upon them in retirement. You have three types. You have traditional, Roth, and then you can have a taxable account or just a regular investment account. With the traditional or the Roth, those are tax qualified. And with traditional, you get to make an investment. You make $100, you take that whole $100, you can invest it. And you don't pay taxes on it right away. It grows tax deferred. And then when you draw it out at age 59 and a half, you'll pay tax on that. It's almost like income tax when you pull it out. With Roth, right, you will make $100. You'll pay the taxes right away, so you only have $85. You invest that $85 of after-tax money. It grows tax deferred. Age 59 and a half comes, you can pull the money out. You don't owe any taxes, which is really kind of cool. And then a taxable account is totally different. On the traditional and the Roth, you either have 401ks, I'm stopped now, just so you know, don't panic, 401ks or IRAs. And each one of those have special rules for contribution limits. 401ks, it's $18,000, and then there's a catch-up for people over a certain age. And I think it's a $6,000 catch-up. They just changed it. So that's how much you can put in a year. And then on IRAs, it's usually, $5,500. I got to go double check. It's been a while since I looked because I don't deal as much in those anymore. But there's a limit to how much you can put into those. A taxable account, it's just a regular account. You could put $100 million into it right away if you wanted to, but here's what happens. There's no special deducting or anything like that, and any activity that happens in the account in that year, you would owe the different versions of taxes on it. And there's all sorts of different ways you would get taxed. You have, if you owned a bond in that taxable account and it kicked out interest, you'd pay tax that you pay regular income tax basically on interest income. If it was a long-term capital gain or a short-term capital gain, you're going to be paying, in fact, there's some really cool things with long-term capital gains if you don't make a ton of money. The bottom line is it doesn't grow tax deferred. And then you have a basis amount on, let's say you own stocks and you have this, you start here and it invests for a long time and you draw it out here. That difference, that growth, you're going to owe long-term capital gain taxes on. So you have to pay attention to that. Therefore, what tax diversification is all about is being careful to think about when you draw the money out, what's going to happen to your income taxes. It's also planning your taxation now, because depending on how your income spikes, remember, the more money you make in our marginal tax world, the higher the taxes that you're going to pay. And there's a couple of stepping stones that can really hit you. Luckily, they all just shifted up with the new tax bill, where you can make more and more income and not have to pay as high of an increased percent on your income. But the core behind tax planning for retirement is that your Social Security, which often is a big part of your overall retirement plan, not for everybody, but for some people, your Social Security will either none of it, or up to 50% of it, or up to 85% of it will be subject to tax. And the more you draw out of taxable IRAs and the traditional stuff, the more you draw that out, that drives your income up. And there's this provisional income number. And basically, it's like between 0 and 34,000, and then over that, what happens is you can create kind of a taxable nightmare for yourself if you're not careful. So tax planning is all about giving yourself flexibility and arriving in retirement with money in all three types of accounts, because you've been managing your overarching lifelong tax bill, because your goal would be to pay your fair share, not a penny more, but to pay taxes once and pay it in the lowest tax bracket possible. So you want to use all three of those tools. I hope that's helpful.